Hey Bowtie Nation, Joseph Hogg here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see and know. We talk about a lot of stocks here on the channel. Some are short-term trades, some are more diversification or cash flow, but only a few make my high conviction list. The stock's at the center of one of three explosive trends shaping the economy. That's what I want to highlight this week. My favorite stocks for the highest potential return. The stocks you need to build your portfolio. Round for the life-changing money. Stick around, and I'll also update you on important news for Amazon. A life financial, and an update to our market outlook this week. Let's get right into those first to stocks, though. And these are from a video I'm putting together for this Wednesday. When I led three more into my top growth, the next decade, cybersecurity. I've been buying heavy into this, the the last few years, and it's Islami's highest conviction investment. Cybersecurity spending is growing at a double-digit pace, expected to hit nearly $400 billion by 2028. This is one of the areas of IT spending that cannot be cut. The average data breach cost companies nearly $5 million, and ransomware attacks hit 72% of larger companies last year. Then digging deeper into this, something I'll detail more on Wednesday is the different pace of growth. For these segments in Thistum, all the way from booming growth of above, 15% for cloud and SaaSes to kind of disappointing, 3 to 5% in legacyferal. And that makes it critical that you know which cybersecurity stocks compete in which segments so know which are going to benefit from the most growth. And here the best tail-around stock in the theme is Palo Alto Networks ticker PNW, which is the only company to compete in every segment, choosing its giant $3 billion in annual cash flow to go wherever companies need security. The company uses an inclusive light firm approach to consolidate offerings into comprehensive suites like Prisma. For SaaS and Cloud Cortex for analytics and AI-driven operations, that means customers are just buying individual tools or standardizing their entire security stacks on the Palo Alto network. Now, because it also competes in some of the slower-growing segments, doesn't have quite their Avaneway growth at just 14%. But it is still a profit machine compared to some of these others in the theme. It's off the least expensive in the group. And again, this entire theme, cybersecurity, it's going to keep paying off for years. But here, I think CrowdStrike Holdings to grow CRWD overtakes Palo Alto Networks as the world's largest cybersecurity company. And I'm loading up. I'm already up 109% on my position. With stock, my 8th largest holding. That's because not only does CrowdStrike lead in several of the industry segments like endpoint security and SIEM, it's building the future of AI cyber. Security that ties all these segments together with its Charlotte AI and agentic cybersecurity assistant. Unlike traditional AI tools that require prompts and manual interpretation, Charlotte operates like a teammate, automating investigations, generating its own scripts, and making recommendations in natural language. At this point, CrowdStrike is unstoppable. Company captures over 1 trillion security events per day, fueling both Charlotte's AI learning and their all-time threat graph that underpins its detection capabilities. Now I want to get to those 5 other high-conviction stocks to buy. So make sure you subscribe so you don't miss Wednesday's video where I'm going to detail the research and the 3 other cybersecurity stocks to buy. Now, these next 2 stocks are from a new theme I'm following, the push to stable coin regulation in the US with the Genius Act. Shares of the Grayscale Ethereum Trust, ticker ETH, are up 16% just in the week since highlighting it in last Monday's update. More than double through upside in both Bitcoin and Solana. And Pfizer, ticker Phi, still looks like an undiscovered opportunity. In this space now, I outlined last week the rare bipartisan support for stablecoin legislation that is driving this faster than anyone expected. With everyone from JP Morgan to Amazon and Walmart positioning for a new era of digital money, McKinsey estimates the market for tokenized assets on which those stablecoins play their role could jump at least 8-fold by 2032, $2 trillion. Now folks, to understand why stablecoins are definitely going to happen, what you need is one chart to keep their values pegged to the dollar, Stablecoins like Tether invest two-thirds or more of their assets in U.S. Treasuries, with $156 billion in assets. Tether has bought over $98.5 billion in Treasury bills, from which it earns interest and backs the currency. Remember, selling Treasury debt is how the government pays $4 trillion in deficit spending and the $37 trillion it already owes. The interest rate the government thus had to pay on these treasuries has jumped this year as investors worry. That spending is out of control, and the U.S. lost its last AAA rating. But what if government could find someone to buy another $2 trillion of these bonds and force those rates lower? And that's where we see stablecoins coming in, and we, everyone in Washington, is so eager to get this passed at about $250 billion. Now, that 65% or so of those stablecoin assets invested in treasuries comes out to about $162 billion. With regulation, Washington could mandate even more of those assets are put into treasuries. And if the market were to grow to just $3 trillion forecast, that's another $2 trillion in treasury demand to fund all of Washington's pork spending. That this has taken shares of Circle Internet Group to grow CRCL of 500% just since its IPO last month. But I'm going with a guaranteed winner here, Ethereum, which dominates the market as the infrastructure that makes all this possible. Now in this, I also like Pfizer, which I highlighted last month's financial juggernaut, with the old school networks to beat Circle at its hound game. Fusarv announced a week ago a plan to launch its own stablecoin and platform for clients, instantly hooking it into the 10,000 plus institutions for which it processes payments and services. While valuations have gotten a little stretched on these next few stocks, Super Microcomputer, ticker SMCI, is still trading at a steep discount to its fair value. Folks, this is a company with a lock on the Icever growth theme and expected to grow raving by 47% this year to $22 billion. Shares are up 60% this year. And I'm up for 6% on my average cost, a gain of over $400,000. So far, while that's taken the stock back, told most 1.5 times on a price-to-sales valuation, still the best deal in AI stocks, by a long shot on forecast for $30 billion in sales next year. And Avena at 1.65 times price-to-sales valuation, which would still be cheap. You're looking at a $50 billion market cap and an $82 share price, and I think that is a low target here. Another stock that's doubled since I started recommending it last year. But with more upside to go, SoundHound AI, ticker SU, company Thetis, positioning itself to be the leader in the $160 billion voice assistant AI market. That's because instead of converting voice to text and then analyzing the meaning like a lot of other companies are doing, SoundHound's platform interprets meaning directly from voice faster and with fewer errors in real-world environments. The company has already landed partnerships with Hyundai, Mercedes-Benz, MasterCard, and White Castle, integrating its real-time voice assistant into cars, payment terminals, and drive-thrus. And wealthy 44 times price-to-sales valuation would normally have me avoiding this stock as just too damn expensive. Y'all have to put that market potential and the competitive position in perspective here. Even a 10% market share of the $160 billion voice AI market would be $16 billion in sales. That is 100 times the company's forecasted revenue for this year. That means this one just keeps on growing. SoundHound could easily be a $200 stock over the next 5 years, and I keep buying more. Now those first 6 stocks I'm still loading up on 4 strong growth and reasonable valuations. These next 3 stocks I'm still holding and are big winners in my portfolio. Beauty of runs so far so fast. The long-term upside is still there. But I do worry about some short-term valuation risk. That includes SoFi Technologies, ticker SoFi, up 218%. In the last year alone, with a gain of 174% since I've started buying, and $177,000 profit. I still think this becomes a major bank and takes shares higher over the next 5 years. But that price-to-book valuation of almost 3.5 times is just too expensive for a bank stock. So, I'm holding here and waiting for a better price to buy more. Shares of Advanced Micro Devices, ticker AMD, have also had a hell of a run. up 88% since April and up 27% since I started recommending it earlier this year. While it's not a super expensive compared to other A stocks, at just 8.5 times price-to-sales valuation. That is still quite a bit more expensive than it traded just over the last 2 quarters. So, I'm worried about a little bit of a pullbacker. Now, I think it's still worth at least $160 a share and higher over a thale long term, but the easy money is probably out right now. And Symbotic, ticker SYM, a stock that has doubled just this year at my 4th largest holding. It's up 98% on my average cost. This is a tough call because I still believe Symbotic is going to revolutionize that $1.2 trillion U.S. warehouse market. And that opportunity dwarfs its current $2.2 billion in sales, ensuring 20% plus growth for years to come. But anytime stock doubles so quickly, and here is trading at 12 times on a price-to-forecasted sales basis, is the cheap-ass NM starts to get kinda itchy. I sure as hell am not selling at this point, but I do want to wait for any dips to buy more. Looking at the stocks I'm watching this week, bank stocks start use off on our second quarter earnings season, Tuesday, and could have some surprises waiting for dividend investors. The results of the Federal Reserve's most recent stress test of 22 largest U.S. banks showed all were well positioned to survive recessions with strong capital levels, clearing the way for these banks to pay out larger shares off their earnings as dividends. That news sent the Spider S&P Bank ETF, ticker KBE, up 5% just this month and with more on the way. BlackRock, JP Morgan, Krupp, Wells Fargo all report earnings Tuesday, followed by Goldman Sachs and Bank of America on Wednesday. Of these, Goldman Sachs and Wells Fargo are only paying out 27% of their earnings to cover their dividends. WHILE, JP Morgan, and Krupp pay out about 31% off their earnings. Wells Fargo looks particularly attractive here with a higher 2% dividend and recent wrap-up OFITs. Other regulatory problems? I'm also watching Ally Financial, ticker Ally. It's going to be reporting its earnings on Friday. It is also attractive on that valuation and what could be a surprise upside to earnings. The online bank is expected to see revenue fall by 2% this year. But I think this gets up grady digger. Even with the tapling weakness, earnings are expected to jump 48% this year on that cost cutting. Now at a price of just over 1 times its book value and with a 3% dividend yield. It's a good pick against other favorites like SoFi that have just gotten too expensive. Amazon Inc., ticker Amazon doesn't report until August 7th. But I'm watching these e-commerce and related stocks closely this quarter. A survey by Alex Partners found that online shopping saw its biggest dip in more than a decade over the first half of 2025, largely due to fears over those tariffs and shipping. Kana. More than a third, 34% off consumers said they delayed purchases, leading to decreases as high as 13% and home delivery orders online from last year. And the biggest drop here was in-office supplies, down 13% last year. It's followed by sporting goods down 12%, cosmetics, electronics, and home furnishings down 10%. While the grocery category was the lone standout, reporting flat from last year. Now, aloft this might make it difficult for Amazon, which has rebounded 34% from its April low, to come through on its second quarter results or its fuller outlook. Against this bad news, I still do like its trade desk to TTD on its best-in-class ad. Platform and belief stock is going to jump once those in-line sales return to growth. You'll want to use that bigger picture here with Thaw Sector Spider Sector Tracker. 5 off the 11 stock sectors did close higher last week with energy stocks, jumping off those oversold conditions, even as the price of oil didn't move. While stocks in the utility sector held their traditional safe haven status, other safe haven sectors, like consumer staples and healthcare, failed to shield investors in thought-down market. What we're seeing, Horea's uncertain policy and regulation erigis, appending those old investing ideas, making harder to build a portfolio and strategy. We are seeing a gap is building between the price performance of stocks in the healthcare sector and their fundamentals, with the group down 1.7% so far this year, despite the fact that the sector is seen posting third best earnings growth for the year, profits expected up 13%, well above the market. Now uncertain regulation tariffs are weighing on this sector, but it's quickly becoming a very good deal that could bounce back anytime. Stocks in the healthcare sector no trade for an average price of just 16.4 times their expected earnings. That forward PE ratio that is the only sector trading at or below its 10-year average PE ratio, with most of the market trading at very expensive levels. That gap has moved healthcare into the top spot for analyst expected returns, with forecasts for the group up 15% to target price over the next year above real estate, which is expected up 12%, and energy stocks up 11%. Favorites in the group include Insulet Corporation, took her Gilead Sciences, Guild and device maker Medtronic took her MDT, updating her market outlook. It is going to be a very busy week for investors. Starting us off with what's being called Crypto Week in Washington, where the House is going to vote on both the Genius Act and the Clarity Act, which is first going to create a regulatory framework for stablecoins and define who between the SEC and the CFTC is going to have oversight. Again, this is one of the few areas in Washington that has support from both Republicans and Democrats. Crypto is going to become a bigger player in the economy. We'll see the Alimpertankenserm price index. The CPI measure off inflation on Tuesday, with forecast for prices to have jumped 2.7%. From last year, well above the 2.4% pace off inflation reported last week. I highlighted data we've researched showed department store price shave jumped over the last 2 months, and warned that this Tuesday could be the inflection point to those market fears. That forecast for 2.7% inflation would be a big headline number, and it's likely to take stocks off their highs set last week. We'll also see retail sales data on Thursday, and while it's expected to show some improvement from the month before, retailers are likely to start showing a weakening consumer, which is going to also weigh on the market. And again, those big banks get us started on second quarter earning season Tuesday, with the forecast for stocks in the S&P 500 to have grown their profits by just 4.8% from last year. It'll mark lowest earnings growth in more than a year. But it's even worse at the store level, with just 2 groups, communication services and tech stocks, expected to post growth above that 5% average. 5 of the 11 stock sectors expected to post earnings declines from last year, with energy stocks seeing profits plunge by 25% from that same period a year ago. Nation, that is not a good setup considering stocks are making new all-time highs. Market valuation has jumped back to its most expensive in years. At 6,259 on the index, stocks in the S&P 500 are trading at more than 22 times forecasted earnings over the next year. That is 21% more expensive than the 10-year average PE ratio. Expensive, as stocks have been since the per expensive market of 2021. Now, assured an option strategy last week that can protect your portfolio from a market dip while still giving your individual stocks upside room to run. Using put options with the August 15th expiration products around this month's inflation data, earnings, and the expiration of those tariff deadlines, all 3 big catalysts for a sell-off. Buying a put option on the S&P 500 ETF, that's buy at the $610 strike price for $5.70 per share, and at the same time, selling the puts at the $600 strike for $3.94 each means my total cost for this protection is just $1.76 per share. What that means, if the market index ETF, the SPY, falls just 3.7% below $600 each, that put spread is going to be worth $10 a share for a 468% return, almost 5 times my money. So, if the market does correct lower, that put strategy is going to protect my portfolio from falling too hard. And the best part is, if the market doesn't turn lower, my individual stocks are going to continue a GUR and cover that small loss on that protection strategy. If you want to see more of these option strategies I use to boost, return, and protect my portfolio, get your $150 discount to our options investing course and a 14-day free trial with the link I'll leave in the description. Everything you need to get started, including the strategy finder and options calculator. Don't forget to join the Let's Talk Money community by hitting that subscribe button and clicking the bell notification.